Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to Ian Stafford-Taylor, CEO of Equals Group, a leading fintech, forex and e-payment firm serving largely small and medium-sized companies. So welcome, Ian.
Thanks, Paul.
Now, I've been investing seriously for the last 30 odd years, and when a company puts out a positives trading update and then the shares drop by sort of 10% at the bell, it just is like, it's very strange to me. I'm guessing it was just a sort of sell on the news reaction. There's only a small number of shareholders that actually were participating, but I don't know if you had any take on it.
Maybe a minor amount of profit taking. We'd had a little bit of a run up. I'm quite sanguine about it because I think what the last 12 months has taught us is that, we needed to do some quite strong actions to get through the whole COVID crisis, etc., which we've done. And it takes time for the news to filter through and for things to, people, investors to understand where we're going. And partly that's our own fault for not telling the story well enough, maybe. So listen, I would obviously prefer there was a more positive reaction than that, but it was a very sort of sensible and conservative statement that we made anyway, and we'll build on that. I think so. I'm looking more forwards than I am just on the one.
Yeah, no, I could totally understand that. I mean, again, just as an investor, I take more sort of like indicators from what the serious money's doing, and I know Crystal Amber, the largest shareholder, I think they had 21% back in early September or late August, and now they've got 25%. So clearly they are very positive. And I saw the directors, yourself and the chairman and the CFO also sort of like adding to their position. So as an indicator of future where the company's direction is, I have a bit more confidence on what the serious monies do rather than the daily gyrations of the market. Anyway,
I think there's two things to draw out though, Paul. In terms of for everyone to understand is that we clearly, and COVID advanced it, had to then get down back to our fighting weight. We've done a lot in the 2 years previously. That means headcount, cost, and this, that, and the other. That sort of slimming down exercise has been done, but it's never done. It's a constant thing. I think I mentioned last time that myself and the CFO sit with every exec member every month and go through the payroll name by name and make sure that we're not sort of adding people when we don't need them. So that whole kind of right sizing exercise, but that only gets you so far. What you also need is the growth story. And in the RNS, we said that the B2B side of the business has grown 9% in this year. Whatever yardstick you want to take for how economic activity has been damaged, the UK.
Well, GDP is projected to be 10% down, isn't it, year on year?
Yeah, so we've got an underlying growth story here, which I've always pretty much said when I've been asked that the natural heartbeat of growth for the business is 15 to 20%. It's right there, even in a year like this. So,
what can you do when GDP doesn't decline by 10%?
Yeah, well, I think we're in a very good position to take advantage of what we've had a vaccine approved for use this morning, and
okay, great.
So the Pfizer one was literally just announced, and I think we've got reasons to be optimistic for next year. That said, we've come out with sensible numbers and sensible projections. We will definitely don't want to be over promising and under delivering that.
And which parts of the B2B, just on the statement, for just sort of like providing that good intro for the RNS yesterday, which parts of the B2B are growing? I'm guessing it's the international payments and sort of corporate spend parts of it.
Yes, that's really leading the way. And it's interesting to draw out there, whilst the B2B on the banking platform current account side is growing, but maybe not as quickly, that platform facilitates the other products. And, a lot of what we're doing is having this holistic platform that allows you to, with one login, to access all the products or just one of them, whatever you want to do. And the key to that is that whole banking infrastructure that we have, allowing payments to be made efficiently. You couldn't do international payments as well as we do it without that.
Yeah, you've got a one-stop shop.
Yeah.
Okay, basically. And with the on the consumer side, obviously it's been hit and it's struggled a bit coming out of sort of COVID, particularly in the sort of the the second and even the third waves of COVID. How do you see the sort of the B2C side? I mean, I see you've taken out a lot of cost.
Yes, I mean, the migration from Wirecard, that was a massive exercise. It consumed a lot of bodies, if you will, not just normal customer services, but when you're tackling hundreds of thousands of customers and moving, hundreds of thousands of cards and recarding, and you're going to get there's a massive effort that goes behind that. What I would say about the B2C product now on the travel card side is it's on far more efficient rails. It's actually, we earn more revenue for less cost. We've got a brand new product, brand new app. It's very slick, looks nice, works well. Not that we can just leave it alone and do nothing to it, but it's more maintenance than build now. So all that resource that was behind that can now be directed to the B2B side. We're already pushing B2B anyway, but even more firepower now. We had to do that migration. But when you think about next year, we have to, the travel industry is quite optimistic about a rebound in terms of people going abroad. In our projections, we're assuming better than this year, but certainly not back to 2019 types of levels. We're being conservative, but I'm very optimistic about it because we've got a lean operating model for that now.
Yeah, I think there's a lot of pent-up demand both on the business side and the consumer side for next year. Once we sort of hit the spring and we get mass immunisation programs, you could really see that unleashing a tremendous wave of optimism and spend, because people who have been cooped up like me for sort of like last 6 months have got a bit of extra money. Well, we want to go abroad and enjoy ourselves.
Well, I don't know about other companies, but we've allowed people to carry holidays forward because they couldn't take them. Yeah. And it's actually going to be, possibly a GDP hit from everyone being on holiday
at the same time.
Let's hope so. Because, we all need a sanity.
If you could just sort of square a circle on one thing, I know, just doing my own sort of estimates, the turnover was 13.8 in H1. And I've got sort of 14.3 for H2. And in H1, we did an adjusted EBITDA of 0.7, and we're sort of predicting a flat for H2. Now, I'm guessing a lot of that is because you've got the Wirecard extra costs in there, and you haven't got the benefit of the furlough scheme as well in the second half as you had in the first half. And also you've got a bit of margin, you've got a bit of product mix as well in terms of, I think the gross margins was 63% first half, and next year looking at 62. So is it sort of like a lot of moving parts there, but the underlying cost base has been driven down?
Yeah, the underlying cost base has been driven down significantly. And, with costs, it takes, time for you to see the real effect of that. We'll see the real effect of that in 2021. I think your numbers from memory are pretty sensible in that regard. And as I mentioned earlier, we won't take the foot off the gas there. I mean, listen, we're being sensible and conservative. Who knows what happens in December? I know it's only 1 month and we've done 11 of them.
Yeah.
So, we don't want to come out with an EBITDA number and then fall short.
Yeah, okay.
We don't want to be in that position ever again.
I mean, the beauty part of it really is that you've got plenty of cash on the balance sheet. You don't need to be aggressive or whatever with your estimates, etc. You've got ample liquidity to take you through the COVID void. And what I like, and I think I'd point to investors to have a really good look, is that you've got this huge wave of positive operating leverage, increasing turnover, reducing costs, and 62% gross margins for next year. So they should have you should have a good engine there for dropping down cash and profits.
Yeah, and I think minor point, but probably worth clarifying. In the statement, we allude to having 7 million of cash. To the extent we've had exceptional items, that's already been spent. That's
right. So they're non-cash, these exceptionals. Non-cash
already cashed.
Yeah, okay, they're already.
So people shouldn't be thinking really we got 5. Far from it. We have 7. So yes, we are in what I would call a robust position, and a big contrast to how we were at the beginning of the year.
Good. And I noticed, with Senkos putting its numbers out, your corporate broker this morning, then the board must be reasonably, certainly more confident about next year, or to actually trigger that, I guess, is that you're feeling having seen where you are and the reopening trade and the vaccinations, your level of visibility and certainty going forward is, I mean, it's almost back to where it was pre-COVID, perhaps not quite as strong as that.
Not quite, and we've got
but you're getting there. To do that, that's quite a big statement of confidence.
Yeah, I mean, listen, obviously we agonised about this. As I said, we don't want to be coming out with numbers and then missing them. But we've been sensible about what we've predicted. But yeah, I think we've, April and May were the real sort of difficult months. And, even when we look at our worst case, if let's say the whole year was like April and May, we've been sensible in what we're predicting. We're not predicting it coming back to completely normal levels, but equally we see growth, we see the world adapting, and we're confident about activity in terms of the numbers that we've put out.
Yeah, and just sort of modelling that sort of longer term, sort of like if you do on your B2B side sort of 15-20% per annum organic, and that's 70-75% of the actual business, and even if you've got flat B2C, just doing the maths, that means you've got double-digit top-line growth for the business going forward. I'm not missing anything. That looks reasonable, and I think that's what Senkos is saying anyway.
Yeah, well, it must be right then.
Okay, that's good. Just in terms of the integration of the recent acquisition, Effective FX, how's that progressing?
Oh, great. I mean, I listen, we're very good at doing those international payments businesses of that sort of size now. The two people that came with the business were sat in the office, that morning when we announced it, and were trading 30 minutes later. So
right.
That was seamless. It's performing in line with expectations. So I'm delighted with it. I would do more.
Okay, well, hopefully we'll get an opportunity. And then the other one was for the news when we last spoke was the HomeSend deal, which is the B2B2B. And I think they're a part of, or they're a joint venture with MasterCard. And what that says to me, if industry giant like MasterCard can't do this easily in terms of actual payments into the UK, then you've got to have something pretty spectacular to win that business.
Well, I think that's spot on, and that was it was a long time in the making. I mean, dealing with and they're majority owned by MasterCard, so and a big business that powers actually quite a lot of remittance business. It's one of those businesses you don't necessarily know exists if you're not in the payments world. But as a statement of absolutely right, if we can do this for that size of company with that sophistication, then we have a set of tools here that are, pretty impressive. Meet that yardstick. I mean, they're very demanding in terms of all the various things, as you can imagine, regarding security, robustness, 99.99 of, reliability of systems and all of that. So, I think there's two bits to it. Decent revenue anyway, decent turnover through our platform, and scale means everything in payments, as I keep saying. Plus that kind of badge of honor of, So I'm delighted with it.
Yeah, and what's the exact specific services? Is it basically remittances into the UK from abroad? Yeah. That's what it is. And is it all remittances for HomeSend into the UK?
Well, it won't be HomeSend. They'll have partner companies on the other end of HomeSend. Okay. So it'll be big chunks of dollars that we break into change into sterling and break into lots and lots and lots of little chunks of sterling. So, you'll get tens of millions of dollars coming in, and the typical transaction size the other end is £500. And literally, we just watch it going through. We don't need to touch it. It's straight through processing. How cool is that? The businesses I always like are the ones that make money on the weekends, when the lights are off. And this one does that.
I know we make a distinction between the business side and the consumer side of the actual businesses, but this is effectively what you're saying, is that it's consumers abroad, or sending money or to their families and to people actually in the UK in different currencies. And so that whole transition from COVID to effectively e-payments. I mean, that's a huge wave coming in your direction, as you know, on top of the very strong B2B side you have anyway.
Yeah, and of course, it'd be good to get into the reverse direction at some stage, and that means the same sort of sophistication in terms of doing payments outside of the UK, which we're very, very close to on quite a lot of countries now.
Yeah. And what's the pipeline for the B2B2B side? I mean, is there hope that we're going to get something else in the next 6 months?
Well, I'm not going to commit to that.
Yeah, I didn't think you would.
Home sends like the whale. We might.
Yeah. Okay. Understood.
But it certainly won't hurt in terms of announcing that wakes other people up to the fact that we can do this. We do have a couple we're talking to. I mean, they tend to, doing this one means that we have all the APIs. It's far easier for us to do another one. But they are longer sells. So
yeah, okay. And this is all jam on top anyway, because it's sort of like we're assuming the B2B side goes at sort of 15-20%, and this is sort of extra, sort of like nice to have as much as anything. So it's part of, and I would, I mean, again, putting my investor hat on, I would alert people to investors who are interested in this is to look at the valuation. I mean, at 30p where the shares currently trade, it sort of like trades at around about 1.5 times revenues for next year. Businesses in this area go for, when it's taken over, certainly on sort of the consolidating industry, go for about 4 to 6 times as a minimum. And even if you double 1.5 and get to sort of like 3 times, which still would be cheap compared to the sector, you'd be on 60p. So there's plenty of upside if you guys can deliver. There's no doubt about it.
Yeah, it feels that way, doesn't it? As I say, I'm proud of what we've done on the cost side, and what's key now is the growth story. But we've shown that we have a growth story even in a year like we've been having.
Yeah,
so,
yeah. And the operating should be fantastic coming forward in the next few years with a bit of luck. We'll wait and see, obviously. What about the news flow, just finally, on the sort of the next 6 months? And we presumably have a year-end trading update in January, or you just done it? I don't know.
No, for sure. We will come out with something in January to say how the year ended, give some kind of idea on revenues. So give a steer. So yeah, that'll be the next thing in sort of middle January. Typically, we do that.
Okay, well, brilliant. Well, thanks very much for the update again, Ian. Absolutely fascinating to listen to, and I wish you all the best for the close of the year, and more importantly for next year, 2021, particularly when everybody goes abroad.
Thanks, Paul. I appreciate it.
Thank you.